Welcome, everybody. We got a special situation kind of brewing. Bill McKee, obviously, and Andy, good morning. Let's take a look at what's going on in the market by this weekend in our second installment of our weekly mentoring, our summer mentoring. Last week, a week ago, we did summer mentoring looking at several techniques, seasonality, and then it led up to looking at the Commitment of Traders report because that's what we were reviewing. And we had a nice trade that translated into the Japanese yen and an option trade in the FXY for a great setup, a nice trade, and almost just a little more than a double on that. In addition, what I am looking at for this week in reviewing is the Commitment of Traders report and the S&P 500. So I wanted to go over with my website because people, no matter how with the different platforms that everyone uses, from Options Express to eSignal to this, that, and everything else, let me just go straight to the website where you can get the information that's straightforward and reliable. Go to Tools, hit Commitment of Traders on personsplanet.com. It's a one-click wonder. Nothing obstructs you. It doesn't ask for your name, rank, social security, firstborn identification, none of that. Click on Get Report. So now we're 2 clicks into it. Scroll down. Here's the problem with the Commitment of Trader. Or not a problem, but here's an issue, a bit of knowledge you need to know. You just don't click on the product you want to look at. What you need to do is know what exchange that product originally listed as. Remember, the Chicago Merc bought the Board of Trade. ICE bought the CEI and the New York Mercantile Exchange. Remember that. So, but they still list New York Merc products. So that would be coffee, cocoa, sugar. The Chicago Mercantile Exchange, what we want to look at today is the S&P 500 futures. So the S&P, the E-mini S&P, the big S&P was first started on the floor of the Chicago Mercantile Exchange in 1982. Short history lesson, the very first contract that was listed was the September contract. So the symbol letter, the symbiology universal letter for the different corresponding months, June is M, July is N as in Nancy, August is Q, and September is U. So if you take a look at the board on the floor in the old days and you saw the very first listing of the S&P, you saw SP and then U for September contracts, and that was they just nicknamed them the SPOOs. Look, they got the SPOOs up there. And so that's why guys like me that have been around a long time refer to the S&Ps as SPOOs, and the new kids on the block refer to them as the ES, as the ES is the electronic, or the mini Dow they call it as the YM, or the TF, which is the electronic symbols for the Russell, the Dow, and of course the E-mini S&P. So that's the history lesson for those. As this is being recorded, I thought it'd be nice to give you a little history lesson. Now, as we scroll down, if you ever click on that and you find butter, you're in the right place. And yes, they still trade butter, about a total open interest of 8,452. And they have milk, and yes, milk's sort of traded a little bit, but scroll on down, and you'll find all other products here, such as when you get into Russian ruble, Canadian dollar, Swiss franc, Mexican peso, British pound, the yen, which interestingly enough, note that the funds last week added 27,000 shorts. So it looks like they did a short-term profit-taking correction. These guys got out of some longs right there, and these guys actually added more shorts, and the commercials added more longs. So that's as of June 9th, a week ago Tuesday. Remember, the market did rally Monday morning up till Wednesday, so that might change the scope of positions. When you get a 1.5% move in the market, it'll certainly knock out some of the shorts in the market, especially new, fresh shorts in the market. So this report, when we look at the Commitment of Traders, is from a week ago, from starting a week ago, or 2 weeks ago Wednesday, to last Tuesday. This is the accumulation of position as of the last report, and that's when I share with you what are the changes from one report. So if you look at 6/2 on your calendar, you'll say that was Tuesday's close, and if you look at this as of 6/9, it's exactly 7 days. You know this is from the positions that have accumulated or changed from starting on the open of 6/3 to the close of 6/9. All right, now let's scroll down and we're going to look at what I like to look at. Instead of looking at the big S&Ps, we like to look at the E-mini S&Ps. And I may have been talking too much, and I skipped right by. Let's find it here, Euro, Brazilian Real, New Zealand. It should be right in here somewhere. Here we go. All right, yep, too fast on the finger there. I look at the E-mini S&Ps for one specific reason. The small speculators there, the open interest is 3,484,000. You will note that we have a 2-to-1, almost a bigger than, or close to a 2-to-1 long versus short in the S&Ps. In fact, last week, the small speculator added 70,000 new long positions. That's the small speculator, the retail trader, the guy that 80 to 90% of the time does not make money in this market. The retail trader is now long a ratio, percent of open interest, over that danger sign of 14% that we often teach at seminars. So maybe over time we forget to look at the commitment of traders report, but it's important at certain times to find out who's in really control of this market. The speculators added last week, from a week ago Wednesday, or week and a half ago Wednesday to last Tuesday's close, added 70,000 new long positions to their already substantial long position. They're long 497 versus short 287. 14.3% of the overall open interest that's long is held by these guys. Look at the ratio, 8% versus 14, and that reflects right there almost that 2-to-1 ratio. Next, when the small speculators, Bill McKee may remember this, as may Andy, the very first book I wrote over 11 or 12 years ago, The Complete Guide, it was called, to candlesticks and pivot point trading triggers. That first book talked about bullet points on using the Commitment of Traders report. It didn't go into a long written chapter. It went bullet points for fast, easy reading. When the small speculator is one-sided and it's against the commercials and against the hedge funds, typically these guys, the small speculators, will not, generally do not win. So right now, that rule of thumb applies in the market. Let's take a look. The non-commercials, professional hedge funds, the guys that manage money, that get paid on a quarterly basis, a profit, guys that are in the business as a living, that hold a reportable size position. When you open a commodity account, you fill out these account forms, and one of the questions they ask you, is this a hedge account? And you say no. And then the next question is this your own money? And you say yes. That means that you're not a commercial, and that means that you're not managing other people's money. That puts you immediately in the non-reportable position category. If you answer yes, this is an entity, a fund, then you are going into the non-commercial category. All right, whether you trade large positions or whether you trade position size, which each exchange and each commodity has so many contracts that you could trade up to before the exchange reports you to the CFTC and categorizes that you as a non-commercial. So that's someone who holds a long position or someone who is managing money, a professional. But they're still speculators. I want you to note that you'll see long position is 375. So they're definitely long. But look at the shorts. 446. They got more shorts than they got long. And notice that from the prior week, from Wednesday to Tuesday's close, they added 52,000 new short positions. So the non-commercial hedge fund guys are starting to lean more short the market, taking the opposite side of these guys, the speculators. Then let's take a look at the commercials. They increased 92,000 on the short side, 69,000 on the long side, for a net new total of new short positions. They're adding to their hedges to the short side. So the commercials are leaning short, the hedge funds are leaning short, and it's the small speculator carrying the weight of the market on their own shoulders. God bless them. This is something that we have been keeping our eye on in the market. Many people ask me, well, why don't you look at the big one, and what about the consolidation? That's something, the reasons we get into that in our mentoring course or other trading courses, and something that's not for today's discussion. I just wanted to share with you, number one, that you see a huge new net short position or added to short positions by speculators. And to me, not a very positive scenario in the market. On Friday, before we left together, we analyzed a couple stocks in the Dow Jones Industrial Average. I went through the Dow component stocks, and looking at the Dow component stocks, we noted in Dow 30 we had Microsoft. You could see a list of all the names here, and it was almost like every other stock was up, down, according to its direction of volume. This is Microsoft in the technology space. The longer term monthly chart looks, or you can clearly see a potential double top in the market, and on that double top something very subtle exists on a monthly chart. Subtly, we did make new higher closing prices in Microsoft, and unfortunately the volume not only did not make a new high, but it actually closed, and for the last month and a half has traded back beneath its longer term moving average. Not a very warm and fuzzy feeling of market accumulation at the top. It's more of a distribution. When we take a look at the weekly chart on Microsoft, we will note that not only did we generate a low close doji 2 weeks ago, but we also generated a PPS sell signal, which can be found on Genesis, TradeStation, and as well as Thinkorswim's platform. PPS stands for Person's Pivot Study, and that is the momentum indicator that paints an arrow on your chart for buy signals and sell signals, or bullish and bearish momentum. So that can be found under Thinkorswim's studies. Under licensed studies, look for my name, John Person. There's Person's Pivots, and then there's PPS. If you click on PPS, it'll paint arrows, actual arrows on your chart. Up meaning bullish momentum, down arrow meaning a bearish momentum indicator, and I'm sure everyone will figure that out quickly. Needless to say, Microsoft's seasonality, not the greatest time in the year to be buying Microsoft, is what we came to a conclusion. And since there is a gap that exists in the market, we were kind of looking at the potential for this market maybe to get down into this region here. We were hoping to see possibly a rally, a test, or a dip back up into maybe the 47 area, and then look for the market to see this week if it just continues lower. I would have to say that may or may not happen still, depending on today's opening prices and the way that we walked into the game over the weekend, which is kind of interesting in the sense that typically Sunday nights you see these big bad lower openings, and then what happens during the night? They tend to go up. You know, they're not down as sharply as we've seen, except for now. We seem to be trading slightly different. Another stock that we've been talking about that might, and I keep using the term sinister, Apple. And Apple is another one that has, there is something really spooky about Apple in the sense that not only are my indicators all in sell mode, except for in a monthly time frame, and it could be because of the lack of the valuation change from that split on the charts with this charting software. As you can see, it just over time never did catch up, and I'm not sure what that issue is. I'm not the creator of this software. But you will also note, more importantly, but the weekly did generate a sell signal, and this market has struggled at this 130, 134 area. It spikes, it trades lower, it spikes, it trades lower, it spikes, and it's getting tired. It's getting tired because note that the cumulative volume change on a week-to-week basis is moving lower. Prices have tried to move higher, and they have now a divergence in the volume. Seasonally, not the greatest time of the year either to buy this stock. So these names, these two companies may weigh heavily on the Dow going forward. We can take a look at some other names. Home Depot, a very similar type of arcing potential shoulder, head, shoulder in the volume pattern. Some people may consider this to be flagging, but look, month over month over month, we have long shadows in here. We've been in a weekly sell mode. So the question begs, is this a product that is getting ready to make a new lower move, or is this just a potential type of pennant formation for continuation to the upside? I would have to argue that with the way the seasonalities look in this market, weakness going into July, and the way that volume sold off more so as you see a break in volume, making newer lows in the weekly volume change, Home Depot could be another one that could weigh in and be under pressure. The strengths of the market happen to have been in financials. The regional banks, the KIE, which is the insurers, those sectors seem to have been doing quite well. American Express, which we took a trade in several weeks back and had a nice little upside pop, but to be honest with you, it hasn't really gone anywhere since. And when we take a look at another financial company, let's check out Goldman Sachs. While it did have a breakout, and you can clearly see it broke out of old highs here, the volume looks tremendously strong. This is a stock that is about the only sector of the market that is carrying the weight of everything. So the point being is that this is JP Morgan, similar volume pattern. It's almost as if I did not change. Look at this. Watch this. If I go to Goldman Sachs, look at that weekly OBV volume. It doesn't even look like it adjusted or changed. And when you go back to JP Morgan, it shows that it is a industry-wide, it's where the money flow is, and it looks a whole lot different than the money flow or volume accumulation with some of these big tech names. So with that said, let's take a look at Travelers, which is the insurers. It's kind of like the redheaded stepchild to the sector itself. It's property casualty, but when I take a look at other names, or let's take a look at the ETF itself, which is the KIE. It's the S&P 500 Insurance ETF. You'll see, wow, it's quite different makeup in the fact that the sector ETF itself is making a new high on strong volume. So the point that I'm trying to make is there are certain stocks that will weigh in on this market, and while the financials are still the strongest on the board, if we do start to see more rollover to the downside in equities, eventually they'll take a profit or they'll get out. But the strongest, as traders tend to do what? Hold winners and shed losers. So if the market's weak, they tend to sell out the weak stuff first, or the non-performing stocks in their portfolio. That's the one they may lighten up on. Not maybe get out of everything, but lighten up, especially as they have a profit as we get towards this end of quarter, which is, of course, coming up in just 2 weeks, right? So with that said, we take a look at the daily on the S&P 500. We talked last week about a potential upside move, and we had a bit of a difference between the volume readings on Genesis versus TradeStation. We had more of and I wanted to share that with you this week so that you can clearly see. This is a daily chart on the S&P 500, and I want you to focus in on this little blue line. You can see that the on-balance volume here not only did we take out the prior time period, I mean, we took out the volume levels from back into January. We actually took out the volume levels from last October. And then when the market did rally, is what I was trying to share with the room last week. If the market rallies and we get a moving average reject, and you can see there's quite a difference between the moving average, which, believe it or not, are the same setting. So something is a skew between the various platforms. That, as you can see, even looking at the volume analysis, doesn't really reflect that we took out the lows by as much even in October. So there is a difference in the readings between one platform and another. When you rely on volume analysis, it's important to have the right information. So, you know, who do you kind of trust there? It's 10 to 1 to the other. That's what I was getting into last week. Needless to say, the rally last week had no follow-through. It immediately came back. And so we should see, in my estimation, if I trust TradeStation's data, then we look more negative in the market. If I even trust Genesis or Thinkorswim's data, which looks very similar in nature, then let's take a gander at the Qs. The Qs made a rally and did not hit the daily moving average. In fact, you can see right there, traded below. Now, what's contained in the Qs? Biotech and a lot of technology. And so with Apple, and then let's take a look over at the Dow, which Apple's now a component of. Apple, the Dow kind of moved right back up and looks very similar in nature, and you can see that the on-balance volume indicator did pop its head through the moving average, and then on Friday came right back down. So the key is, for me, is that if the market is in what we were talking about last week, a potential AB, if this is a potential C and then D wave, right? The measurement objective from A to B, if you move it over to, let's just go from there to there more or less, and then I go and I paste it to this high level here. We're coming close to a potential area in this zone in time over here. So that would be about another 300-400 point decline, 300-400 point decline in the Dow. Where would that take us? It would take us to that moving average crossover. What a coincidence. So people might be saying, hey, I want to buy a break. Let's buy support against these lows. And then people will be looking, hey, let's buy the near that low. And I think if we do take out that swing low of area of consolidation which existed in April, May, then we come back to test the next level of support, which will be March. But I think the real support will be this level in here, which is the moving average or the average of lows that we said from the beginning in February. That is probably near the 3/4, 9 months worth of typical valuation, which is this gold line. So that's kind of what I would be looking for in the diamonds, especially if we get a daily close underneath these important swing lows. So the volume action dictates lower prices. Friday we talked about, as you can see, we are gapping lower. And Apple and Microsoft, to me, look some of the, in that space, some of the weakest markets in the overall financial areas. In looking at my scans for the week, we had for sell signals, just actual sell signals. And you can see where I ran these on the 13th, right? So Saturday we already did our homework, working diligently. We had 57 sell signals, fresh, brand new sell signals. I had 14 buy signals. So obviously you got more than a 3-to-1 ratio of actual sell signals. High closed dojis for the week. Well, when I look at the regional banks, which is KIE, right, after a huge rally, that's not a high closed doji. A high closed doji is after a break. So I really don't trust, as I went through these, I really don't trust a lot of these high closed doji weeklies. This is Caterpillar. How about weekly low closed dojis? As you can see, there weren't a whole lot of high closed dojis. SanDisk, Seagate, NVIDIA, Linear Technology, Garmin, which was one that we thought would be kind of a buy, which if you didn't get filled, we said cancel those orders. Thank God. and that was in last week's notes. For this week, we're more on the defensive in the marketplace, number one. And number two, I think that we should be maybe looking at some of the weak stocks getting weaker is the theme. Today's close will be just, I hate to say it, paramount. And, it's never, as I always teach you guys, it's never important how a market opens. It's how a market closes. So what I would strongly recommend is follow the close, and if the market does roll over, in other words, if we are going to see continued weakness, then the market, there are people in here that still want to buy the breaks, and it'll jockey back and forth. Every single day we're going to want to watch, be honest with you, every single day we're going to want to watch the advanced decline. Right now for the Monday morning, you can see the S&Ps, the orange line here is 29 and the blue line's 459. That means in the S&P 500, this is a little extreme oversold. 28 stocks, it's beyond the 30 level that I look at in the S&P 500. I've seen it get on extreme bullish days and extreme bearish days down to like under 10, 4, 3, 2, something like that. But it doesn't last long. So at this point in time, we probably are a little over. I wouldn't be selling this breakdown. I'd be looking for rallies, and probably we'll see how the market responds after the lunch hour for today. But make no mistake, if we close underneath, again, to leave you guys with from planning and scanning for the week, if we close underneath this solid purple line of support, which you can draw on your own charts and go back since the April, May, those spike lows. You close underneath that. The next obvious point on charts will be the March lows with those swing points, but I think the true essence of support will come in closer towards if we take those levels out, possibly even in the S&P around the 202 handle, and that is 60 or so S&P points from here. That's going to require more momentum. That's going to require more loss of advanced decline analysis. That's going to take more losses from a broad-based perspective in all segments of the markets, including the Russell, okay? Now, I want to talk about the Russell because as it has been, from a volume perspective, one of the strongest segments of the market, I want you to take a look at this advanced decline because to me, this advanced decline has actually been probably one of the enigmas of the marketplace. In other words, if we tighten up the data, you can see as the market's been rallying in price over time in the Russell, the small cap sector, I mean, we're closer to the highs of a potential double top. Look at the chart pattern of this advanced decline. While this market has been struggling to the upside, the advanced decline has been making lower highs. This in a seasonally, and for the Russell, small cap stocks is the worst time of the year to be buying this stuff. We're kind of positioned for the short side for August bear put spreads, which I think even for the next couple days, we want to be watching not just the price action, but we want to watch the volume action on the decline. And I also would recommend coming back and paying attention, as we will share with you if you don't have these indicators. We will be watching the advanced decline analysis as it relates to my work in the Russell. So if this market is to roll over, we're going to see lower prices on heavier volume. We're going to see more breakdown with the advanced decline analysis, and that will give us possibly a move. My guess is somewhere in this, we come back into this region, and in looking at the IWM, which is probably around the 120, 121 handle, and that's about 30. That's approximately 3 points or 30 big points in the RUT. And the RUT is another ETF that you can trade on with the Russell. It's just not as optionable from a volume and open interest perspective, and that's why we use the IWM. I hope this information serves you well. Obviously, we wanted to be focusing on what's going to make these indexes tick. It's the financial sector that's got the most strength behind it. It's the technology space that's got the most weakness behind it. And we definitely, as we talked Friday in the room, should not be a surprise that we're looking at market weakness and follow through as we were kind of preparing for this. So now that Apple's down to 126 and change, and then MSFT, I would say we're going to have to look for bounces. Microsoft did trade to an intraday low a few minutes ago of 45.18, and I got news for you. I think that the Microsoft gapping lower like that has, it's on its way to the downside, as we discussed on Friday. So, in any event, you guys, we have FOMC as Bill McKee, one of our favorite, of course, the Euro and the Greece drama. But, the market was setting up for this, and this is something that we've been talking about now in our trading room. So, with that said, this is not the time to be, at least now, I am not buying dips here, okay? So let's leave it with that. You guys have a great trading week, and I'll be back with the trading room page in just a second. Thank you all very much. That concludes this week's planning and scanning. Thank you.